This is David Schlossberg from Assured Concepts Group with your May 2015 Educational Economic Update. In this month's video, I'm going to talk about some of the major economic headlines from last month and give you some insight into what they might mean for you as an investor. The Fed Reserve was in the news a lot last month as economists continue to debate raising interest rates. Let's go back to basics for a moment. Investors care about interest rates because they affect a lot of things: bond prices, mortgage rates, corporate lending, and inflation. And all of those items can impact equities as well. If you own bonds, you will see that when interest rates go up, the value of your bond holdings tends to go down as new bonds paying higher interest rates come onto the market. If you're in the market for a car or house, higher interest rates will translate into higher loan rates and larger monthly payments. Businesses will also have to pay higher rates for credit, which can then translate into millions or billions of dollars in extra costs. So why is the Fed going to raise rates? Well, the short answer is that they need to get back to normal monetary policy to fight inflation, which can become a problem in ultra-low interest rate environments. To boost the economy after the last financial crisis, the Fed kept interest rates artificially low. Now that the economy is doing better, the Fed wants to slowly bring rates back up. However, the latest data shows that the economy may still be vulnerable to shocks, and the Fed does not want to rush interest rate hikes. At the end of May, economists released revised first quarter gross domestic product growth numbers. We found out that the economy actually shrank 0.7% last quarter instead of growing. While the news is not unexpected, it is not welcome, because it means that the economic recovery still has not reached escape velocity. The contraction appears to have been the result of a harsh winter, a strong dollar, and reduced business demand. Though we do not yet have data on the spring quarter, many economists expect a significant rebound in economic growth. We have seen estimates ranging from a low of 1% up to 3.2%. So it's clear that there's a lot of room for debate on the economy right now. On the positive front, recent employment data shows that the economy added 223,000 new jobs in April, pushing the unemployment rate down to 5.4%. Wage growth also edged higher as some workers were able to earn higher paychecks in a more robust job market. In the weeks ahead, investors will be watching for more insight from the Fed into interest rate hikes. They will also be poring over economic reports to see whether first quarter weakness continued in the second quarter. We hope to see further improvements in housing, manufacturing, and consumer spending as the year progresses. As always, we're keeping a close eye on the financial markets and the economic environment. We'll let you know if and when we think changes to client strategies need to be made. That's it for the May Educational Economic Update. And as always, if you have any questions or concerns about what's been discussed, please give our office a call at 847-426-1077. This is David Schlossberg signing off for the month of May 2015. Please remember that nothing we talk about here is a recommendation, and if you'd like to discuss your personal financial situation, please give us a call. We'd be happy to talk.